What's up, knowledge seekers? Have you ever wondered why everyone's talking about digital money? Names like Bitcoin, Ethereum, and Dogecoin are everywhere, from social media to the news. Maybe you've heard stories about people becoming millionaires overnight, or perhaps you've seen others lose their life savings. The world of digital currency seems confusing and intimidating, right? You're probably asking yourself, what exactly makes this internet money so special? How can something that doesn't physically exist be worth thousands of dollars? And why are people so obsessed with something called blockchain? Today, we're going to demystify this entire world. By the end of this video, you'll understand exactly what cryptocurrency is, how it actually functions, and whether it's something you should care about. Let's dive in. Understanding digital currency. Let's start with the basics. The term cryptocurrency breaks down into two parts, crypto and currency. The crypto part comes from cryptography. That's the science of keeping information secure and hidden from prying eyes. Currency simply means a system of money that people use for transactions. So, cryptocurrency is essentially digital money that uses advanced security methods to protect itself, and it lives entirely on computer networks. Unlike the cash in your wallet or the coins in your pocket, you can't hold cryptocurrency in your hands. It exists only as data on computers around the world. Now, you might be thinking, wait, I already use digital money when I tap my card or send money through my banking app. How is this different? Great question. When you use your debit card or mobile banking app, you're still using traditional money like dollars or euros. It's just being moved electronically. A bank or financial institution is always in the middle, controlling and monitoring every transaction. Cryptocurrency works completely differently. It was designed to cut out the middleman entirely. You can send digital currency directly to another person without any bank, government, or company getting involved. This revolutionary idea started in 2009 when someone using the mysterious name Satoshi Nakamoto created Bitcoin. To this day, nobody knows who this person really is. They could be one individual, a group of programmers, or even someone completely different from what we imagine. What we do know is that they wanted to create a form of money that no single authority could control. The original vision was simple: create a peer-to-peer electronic cash system where people could transact directly with each other, just like handing someone physical cash, but over the internet. The goal was financial freedom and independence from traditional banking systems. Here's where it gets interesting, though. While cryptocurrency was designed to be spent like regular money, most people today treat it more like an investment, similar to stocks or gold. In some places like El Salvador, people do use Bitcoin for everyday purchases like coffee or groceries. But for most of the world, cryptocurrency has become a speculative investment where people buy low and hope to sell high. This shift happened because cryptocurrency prices are incredibly unpredictable. Imagine if you bought a sandwich today for $10, but tomorrow, that same sandwich cost $15 or $5, depending on market conditions. Most people find this uncertainty frustrating for daily spending, which is why traditional money remains the preferred choice for regular transactions. From Bitcoin's creation, thousands of other digital currencies have emerged. We call these altcoins, or alternative coins. Some, like Ethereum, serve different purposes beyond just being money. Others, like Dogecoin, started as internet jokes but gained real value. The cryptocurrency ecosystem has exploded into a diverse marketplace of digital assets, technology behind digital money. The magic behind cryptocurrency lies in something called blockchain technology. Think of blockchain like a massive shared record book that everyone can see but no one can cheat. Picture this: Sarah has a ledger where she writes down every transaction that happens in her neighborhood. Once she writes something down, she uses a special permanent ink that can never be erased or changed. But here's the twist: Sarah isn't the only one with this ledger. Every single person in the neighborhood has an identical copy. If someone tries to cheat by changing their copy of the ledger, it becomes immediately obvious because their book doesn't match everyone else's. The community can easily spot the fraud and reject the fake version. Each page in this ledger represents a block of transactions, and when one page fills up, everyone adds a new page, creating a chain of blocks, hence blockchain. In the cryptocurrency world, when someone wants to send digital money, the transaction details get broadcast to a network of computers worldwide. These computers have a very important job. They need to verify that the transaction is legitimate before it gets added to the blockchain. But how do they verify transactions? This is where it gets fascinating. These computers compete to solve extremely complex mathematical problems. It's like a massive worldwide puzzle competition happening 24/7. The first computer to solve the puzzle gets to add the new block of transactions to the blockchain, and as a reward, they receive some newly created cryptocurrency. The people who run these powerful computers are called miners, and this whole process is called mining. It's called mining because, just like mining for gold, it requires work and energy to extract something valuable. The more computing power a miner has, the better their chances of solving puzzles and earning rewards. This mining process serves two crucial purposes. It secures the network by making it extremely difficult to hack, and it creates new cryptocurrency coins as rewards for the miners who maintain the system. It's worth noting that not all cryptocurrencies use this exact method. Some newer systems use different approaches like proof of stake, which we'll explore in future videos. But the core principle remains the same: a decentralized network of computers working together to maintain a secure, transparent record of all transactions, investment potential, and risks. Now for the million-dollar question, literally, is cryptocurrency a smart investment? The answer is complicated, and it depends on your risk tolerance and financial situation. Let's look at some incredible success stories first. If you had purchased Bitcoin in 2010 when it was worth practically nothing, let's say 10 cents per coin, and held onto it until its peak in 2021 when it reached nearly $70,000, you would have seen a return of approximately 700,000 times your investment. That's the kind of return that makes traditional investments look boring by comparison. These astronomical gains have created many cryptocurrency millionaires and even billionaires. Stories of people who bought pizza with Bitcoin that would now be worth millions have become legendary in the crypto community. Early investors in Ethereum, which launched in 2015, have also seen incredible returns. But here's the harsh reality: for every success story, there are countless tales of devastating losses. Cryptocurrency markets are notoriously volatile, meaning prices can swing dramatically in very short periods. We're talking about 30%, 50%, or even 80% price drops happening within days or weeks. Consider this real example. Someone who bought Bitcoin at its peak in late 2017 for around $20,000 per coin watched their investment lose 80% of its value over the following year. If they panic sold at the bottom, they lost most of their money. However, those who held on eventually saw their investment recover and reach new highs by 2021. This extreme volatility exists for several reasons. Unlike traditional markets, cryptocurrency markets are relatively small and can be easily influenced by large purchases or sales. Regulatory announcements from governments can cause massive price swings. Social media sentiment, celebrity endorsements, and news coverage can create buying or selling frenzies. The cryptocurrency market also operates 24/7, unlike stock markets that have set trading hours. This means prices can change dramatically while you're sleeping, leading to pleasant or unpleasant surprises when you wake up. Market psychology plays a huge role too. Many cryptocurrency investors are driven by FOMO, fear of missing out, causing them to buy when prices are. Conversely, when markets crash, fear takes over and people sell at the worst possible times. Essential cryptocurrency terms. Let's clarify some important terms you'll encounter in the cryptocurrency world. Understanding these concepts will help you navigate discussions and make informed decisions. First, let's talk about Bitcoin specifically. Bitcoin is the grandfather of all cryptocurrencies and remains the most recognizable and valuable. Many people refer to it as digital gold because it has a limited supply. Only 21 million Bitcoin will ever exist. This scarcity is built into its programming and is one reason why some people believe its value will continue to increase over time. Next, we have altcoins, which is short for alternative coins. This term refers to every cryptocurrency that isn't Bitcoin. Popular altcoins include Ethereum, which is more like a computer platform than just money, and Solana, which processes transactions very quickly. There are also meme coins like Dogecoin and Shiba Inu, which started as internet jokes but gained real value thanks to community support and celebrity endorsements. Now, let's discuss cryptocurrency wallets, which are quite different from the leather wallet in your pocket. A crypto wallet doesn't actually store your digital currency. That's impossible because cryptocurrency exists on the blockchain network, not in any single location. Instead, your wallet stores something much more important: your cryptographic keys. Think of these keys like the combination to a safe. Your wallet contains two types of keys: a public key and a private key. Your public key is like your mailing address. You can share it with anyone who wants to send you cryptocurrency. Your private key is like the key to your house. It proves you own the cryptocurrency and allows you to spend it. You must never share your private key with anyone. Wallets come in two main varieties: hot wallets and cold wallets. Hot wallets are connected to the internet, making them convenient for frequent transactions but more vulnerable to hackers. Cold wallets store your keys offline, often on a physical device like a USB drive, making them much more secure but less convenient for regular use. Here's a cautionary tale. There's a man in Wales who accidentally threw away a hard drive containing the private keys to 7,500 Bitcoin. At today's prices, that's worth over $200 million. He's been trying to get permission to search the local landfill for years. This shows how important it is to safely back up your private keys. Finally, let's explain forks. A fork occurs when the cryptocurrency community disagrees about how to improve the system. Think of it like a road that splits into two paths. Sometimes these disagreements result in the creation of entirely new cryptocurrencies. For example, Bitcoin Cash was created when some people wanted to make Bitcoin transactions faster, while others preferred to keep the original system unchanged. Benefits and drawbacks. Every revolutionary technology has advantages and disadvantages, and cryptocurrency is no exception. Let's examine both sides fairly. Starting with the benefits, the biggest advantage is decentralization. No single government, bank, or corporation controls cryptocurrency networks. This means no one can arbitrarily freeze your account, block your transactions, or inflate the currency supply for political reasons. For people living under authoritarian governments or in countries with unstable currencies, this represents genuine financial freedom. Accessibility is another major benefit. Traditional banking requires extensive paperwork, credit checks, and often minimum balance requirements. Millions of people worldwide are unbanked. They have no access to basic financial services. Cryptocurrency changes this. Anyone with a smartphone and internet connection can participate in the global economy without anyone's permission. Speed and cost advantages are significant too. Traditional international money transfers can take days and cost substantial fees, especially for smaller amounts. Cryptocurrency transactions can happen within minutes regardless of geographic distance, and fees are often much lower than traditional banking alternatives. Privacy is another key benefit, though it's often misunderstood. Cryptocurrency transactions are pseudonymous, meaning they're linked to wallet addresses rather than real names. While all transactions are recorded on the public blockchain, connecting those transactions to specific individuals requires additional investigation. This provides more privacy than traditional banking, where every transaction is directly tied to your identity. The potential for significant returns cannot be ignored either. Despite the risks, cryptocurrency has created more millionaires per capita than perhaps any other asset class in history. For investors willing to accept high risk, the potential rewards can be life-changing. However, these benefits come with serious drawbacks. Volatility is the most obvious problem. The same price swings that create massive gains can also cause devastating losses. Many people invest money they can't afford to lose, leading to financial ruin when markets crash. This volatility makes cryptocurrency impractical for everyday spending. Businesses can't reasonably price their products in a currency that might lose 20% of its value overnight. This defeats the original purpose of cryptocurrency as a replacement for traditional money. Regulatory uncertainty creates additional problems. Governments worldwide are still figuring out how to handle cryptocurrency. New regulations can appear suddenly, dramatically affecting prices and usability. Some countries have banned cryptocurrency entirely, while others embrace it. This regulatory patchwork creates confusion and risk for users. The irreversible nature of cryptocurrency transactions is both a feature and a bug. While it prevents banks from reversing transactions arbitrarily, it also means that mistakes are permanent. If you accidentally send cryptocurrency to the wrong address, or if you fall victim to a scam, there's no customer service department to call for help. Speaking of scams, the cryptocurrency world is unfortunately filled with fraudsters. Common scams include fake investment platforms that steal your money, phishing websites that trick you into revealing your private keys, and pump-and-dump schemes where scammers artificially inflate the price of worthless coins before selling their holdings and crashing the price. The lack of consumer protection means you're essentially your own bank, with all the responsibilities that entails. If you lose your private keys, your cryptocurrency is gone forever. If your computer gets hacked, you might lose everything. There's no FDIC insurance or bank guarantee to protect you. Environmental concerns have also become significant. The mining process for Bitcoin and some other cryptocurrencies requires enormous amounts of electricity. Some estimates suggest Bitcoin mining uses more electricity than entire countries. This environmental impact has led to criticism and regulatory pressure in some regions. Final advice. So, should you get involved with cryptocurrency? The honest answer is, it depends entirely on your personal situation, risk tolerance, and financial goals. If you're curious about cryptocurrency, start by educating yourself thoroughly. Don't rely solely on this video or any single source of information. Read white papers, understand the technology, and learn about the specific cryptocurrencies that interest you. Knowledge is your best protection against both losses and scams. Never invest more than you can afford to lose completely. Treat cryptocurrency like gambling, not like a guaranteed investment. The potential for high returns comes with equally high risks of total loss. If you decide to invest, start small and gradually increase your holdings as you gain experience and confidence. Don't let FOMO drive you to make impulsive decisions during market highs or lows. Choose reputable exchanges and wallet providers. Enable all available security features and back up your private keys safely. Consider using dollar-cost averaging, investing small amounts regularly over time to reduce the impact of volatility. Most importantly, remember that cryptocurrency is still an experimental technology. While it has the potential to revolutionize finance, it could also fail or be replaced by something better. Only invest what you're comfortable potentially losing, and always prioritize your financial security and well-being over potential profits. The future of money is still being written, and cryptocurrency is certainly part of that story. Whether you choose to participate or simply observe from the sidelines, understanding this technology will help you navigate our increasingly digital world. If you found this explanation helpful, smash that like button and subscribe for more beginner-friendly breakdowns of complex topics. What cryptocurrency topic would you like us to explain next? Comments below.